So one recurring comment that people have made around my channel has been, yo, tenbagger, why do you choose to cover these sleepy companies versus higher growth or sexy names? Like, are you incapable of covering tech? Well, the fact of the matter is I created this YouTube channel back in 2021, not 2020, where a lot of the tech names near and dear to your heart have already run up big time. My job is not to be tech only or cyclical only, but an S&P alpha investor. And given that I'm up about 60% year to date, or more than twice the return of the S&P 500, I would say that I've largely succeeded in that. Case in point, I could have pitched Palantir stock back in April of 2021 for $25 per share, but what would that have earned my viewers and subscribers? Not to mention myself, because I personally put every single dollar behind all my stock picks, a nice minus 15%. Meanwhile, some of my quote-unquote sleepy picks in the financial space have rallied to be tied with energy as the best performing stocks of 2021. It's not because I love covering financials and cyclicals, but you have to take into account the market environment. So many YouTubers out there, they only do tech or believe that you can only get big time returns by investing in tech. And I think that's a bit of a disservice to you guys in addition to just being flat out wrong. All right, this is not going to be a deep dive video on Palantir, but a tactical call. I know lots of you are already familiar with the name, so I'll just summarize them super quick. Palantir is a software company dealing with big data analytics. They operate two different segments, Gotham and Foundry. Gotham is designed more for your government agencies. Foundry is geared towards the private sector. They've been building the technology for a better part of 2 decades and rose to prominence on several different occasions, but especially when it was revealed that their software had played a pivotal role leading to the capture of Osama bin Laden. Today, their analytics suite powers decision-making in a wide range of sectors, from defense to automotive to healthcare and many more. The company has been growing top line at a pretty good 35 to 50% clip, maintains very healthy gross margins of about 78% as of Q3, and remains one of the hottest, most hyped stocks in the market. Now let's get into the meat of the video where we'll talk about whether you should invest or not. If you recall, the stock was trading in the low 20s last year, and outside of that Reddit-fueled meme spike, has done absolutely nothing over the past year or so. A bit frustrating, but absolutely nothing. There's a key technicality here. Keep in mind that the stock price is different from the company's market cap, which has in fact soared to about 45 billion, meaning the market value of the company has more than doubled while the shares have stayed flat. And the reason for this comes down to dilution. Analysts, investors, even Redditors, they all tend to view this company as a stock dilution machine. Now, depending on whether you're an employee or a shareholder, this can be good or bad. The reason for this, and Alex Karp has gotten a lot of flack for, is he told employees that they would get a percentage of the contracts as stock back when they went public. And he's been paying this out over time, but it's being heavily phased out. The dilution has put a cap on Palantir's upside because there's just so much of it going on. Usually when companies issue shares, it's not a huge amount, maybe a few percentage points of an increase on the share-based compensation line. Heck, even when American Airlines and Carnival Cruise Lines were trying to literally save themselves in a desperate bid to raise cash, it wasn't this bad. So the dilution is definitely something to pay attention to. You can grow 40%, 50% year over year, but if your dilution increases by 100%, then mathematically you have to double your market cap just to get back to the same share price, which is exactly what has happened to Palantir. If you look at the stock chart, the company has been completely range bound between this $21 and $29 range over the past year or so. And the reason is the dilution and the associated share-based compensation. Basically, you, the shareholder or sucker, has been paying the equity comp part of the employee pay packages, except in the case of Palantir, they're just absolutely enormous. Let's dig into that. When analysts asked Karp why he was selling so much, it appears due to a combination of taxes and valuation, but mostly the former. When you receive about $1 billion and you're taxed on that amount, and you're the CEO of a software company making 250 grand outside of your stock-based comp, you really don't have too much liquidity outside of selling your holdings in order to raise cash. So yeah, love it or hate him, that guy is responsible for the vast majority of insider sales in Q3, but he still owns a very significant amount, 6.4 million Class A shares and 36 million Class B shares. That being said, the very positive development here is that they look like they've been on a path to containing the bulk of it going forward. There was a big spike in stock option comp expense in Q3 of 2020, but that has largely tapered off and has continued to decrease. To put this number into context, Palantir has 1.9 or roughly 1.9 billion shares in the market, and insiders dumped about 13 million of it in the third quarter, or about 0.8% dilution. Compared to Q1 and at any point in time last year, these guys are way down in terms of dilution. From a technical perspective, if we go back to our stock chart, which again has been range bound from $21 to $29 per share, you'll notice something particularly encouraging, and that is the company has been making higher and higher lows. And $21 per share looks to be a very solid support area. If we see a bounce at 22, that would certainly be a very good sign. With Palantir, I think we're close to the bottom, but we're not quite there yet. And the reason doesn't have to do too much with Palantir, but more with the market conditions, market sentiment. And I like to use this thing called the CNN Fear and Greed Index to look at where we are in that cycle. So when the company released earnings and dipped about 10%, I didn't buy into the dip because this index was just too damn high. It went as high as 86, or squarely within the extreme greed territory, before coming down to a more reasonable 69 today. But that move, guys, has been a straight free fall over the span of just 1 to 2 days. If we look at the Fear and Greed Index over time, back in 2018, 2019, 2020, what we'll see is that there's usually one big spike down corresponding to tax loss harvesting right before the holidays around Thanksgiving, before a massive year-end rally. So if history is any indication, I would say that we probably get one big re-rating that sinks the Fear and Greed Index to a more reasonable level before that massive rally. Now, with the technical and macro setup out of the way, the last thing I want to touch on is guidance, because the way to beat share-based compensation dilution, as you know, with some of these tech companies, is by finding companies that can grow top line fast enough and become big enough in the market to effectively offset that. And as a general rule with guidance, you should pay more attention to those of companies that release later in the cycle, because by mid-November, by the time Palantir had released, they already have a pretty good idea of how they're going to end the quarter. While revenue growth has slowed for 2 consecutive quarters, going from 49% to 36% in Q3, that understandably could have left some people worried. But the good news is, as the company is halfway through Q4, they increased revenue guidance to about 418 million, way above the 401 estimate for the fourth quarter that analysts were predicting, so it looks like we're most likely getting a sound beat here. Now, why did the stock price fall then? Well, it looks like the bulk of the share price damage has come down to margin. Now, Wall Street, in my opinion, is going through a bit of a phase right now where they're more focused on margin than ever, and for a number of reasons. First of all, you might have heard the headlines around inflation, how there's so much of it, and that's putting some margin pressure. But for your tech companies, it more comes down to competition. Wall Street hates competition. Now, early in the cycle, the name of the game was to grow at any cost, but now it has shifted more towards these margin pressures. Investors are looking for companies that can exercise their market power unencumbered by competition and raise prices on customers again and again and again. The key difference here is that Palantir's operating margins are declining, not their gross margins. So what that tells me as an investor is that competitive pressures aren't really there. In terms of this big data analytics / AI moat that Palantir has built around itself, nobody can yet touch this company. Not yet. And while we're at it, this is a great time to debunk the myth that Palantir is not a tech company but relies on these large, chunky, one-time contracts. Tell me any other consulting firm that has gross margins in the 75 to 80% range, and I will show you a ton of dollars to invest. Anyway, the large contracts part is true, but that in itself isn't all that worrisome. Your small and medium-sized companies just don't have the use cases or the capacity or the funding to invest in software such as this, and for that reason, Palantir doesn't actually disclose SMBs as part of its total addressable market. Now, going back to operating margin pressure tells me a very different story. It tells me they're either hiring more, ramping up R&D, maybe boosting their sales and marketing efforts, which, if the last one is true, is probably the only potentially concerning takeaway if it costs them to purchase more incremental revenue. But again, I'm not terribly worried. Operating margin pressures, generally speaking, are more of a self-inflicted wound. In terms of the actual numbers, they were going from operating margins of greater than 30% for the third straight quarter, and then dropping all the way down to 22%, which is slightly concerning, but you should note that they've guided 22% for the third quarter and beat that soundly. We shouldn't rule out the possibility of them being able to do that again. But more importantly, you could argue if that's really what caused the sell-off from $26 all the way down to 21.5, then that is more than priced in. In terms of segment performance, things are looking very good. Commercial growth of 103% year over year is very encouraging for a business that is looking to diversify more from its government sector. 34 new commercial customers in the third quarter is also an excellent result, as it shows there is at least linear growth in customers. Revenue growth should scale higher as quarters progress due to the scale nature of Palantir, so my view is that we'll continue to see high commercial growth on a year-over-year basis. That means full year revenue will at least hit about 1.53 billion for a growth of about 40% year over year, plus 30% annualized revenue growth from 2021 to 2025, which means only a 10% slowdown, which is really, really good, by the way. It shows that Palantir believes it can continue to be a growth compounding machine. So getting back to valuation, like I mentioned, even though the stock price hasn't changed, the dilution has caused the market cap to more than double to 45 billion. But if we assume 35% revenue growth on top of that for 2022, a 20 to 21 forward revenue multiple isn't all that crazy for this type of business. It's certainly not the 60 to 70x forward, which something like a CrowdStrike trades at, for instance. So where does that leave me? My personal opinion, and obviously you should always do your homework, is that this dip is probably a good one technically and fundamentally to load up on Palantir, but you have to be careful of the macro environment. With the fear and greed index pretty high right now, it could certainly get worse before it gets better, but to be absolutely crystal clear, I do think that we see a buyable dip soon, and I will be personally loading up on shares. Good luck. Thanks so much for watching. As always, nothing is more valuable than your time, except for maybe your money, and I'll catch you on the next one. Peace out.